Good day, everyone. My name is Arundhati PR, and I'm a first year MBA student at Alabama Institute of Management. And today I'm going to do a presentation on topic accounting conventions and introduction to IFRS as part of our Accountings for Management paper. This topic explains how accounting maintains reliability and how global standards like IFRS brings uniformity across countries. So let's dive into the topic. Introduction. Accounting aims to provide a true and a fair view of business activities. When there are no specific rules, accountants follow these conventions for guidance. These conventions make report consistent, comparable, and reliable. So, on a global level, IFRS ensures uniform financial reporting across countries. What are accounting conventions? Accounting conventions are generally accepted practices followed in accounting. They are used when standards do not cover certain transactions. So, these conventions are used by accountants when they need help in situations where formal accounting standards do not apply. And it is not legally binding, but widely accepted. They ensure transparency and accuracy in financial information, and they promote the consistency and reliability in the accounts. Also, in financial reporting, relationship with accounting standards. So now let's dive on to accounting standards and accounting conventions and their relationship. Accounting standards are official rules set by accounting bodies, while accounting conventions are informal practices accepted over time. So, accounting standards has official rules set by authorities, while conventions and informal traditions developed over time. Standards override conventions when both apply in accounting standards. And in accounting conventions, conventions fill the gap left by accounting standards. However, conventions fill the gap left by standards. Together, they make the financial reporting complete and dependable. Now, let's move on to types of accounting conventions. There are four major accounting conventions, which is conservatism or prudence, consistency, materiality, and full disclosure. Each helps to improve the quality and reliability of financial statements. Let's move on to each of these topics individually. First one is conservatism. Conservatism means a principle that advises the accountant to be cautious. It means recording all expected losses immediately but not recording any profit until it is realized. For example, if market value of inventory falls below costs, we record the lower value. This avoids overstating assets or income and gives a realistic view of the company's financial position. This approach prevents exaggeration of companies' financial health. For instance, when valuing inventory, we record it at cost or market value, whichever is lower, to avoid showing unrealized profit. Let's move on to consistency. Consistency means that the same accounting methods should be used every year. This allows fair comparison between one year's result and another year's. If a company changes its method of accounting, it must disclose the reason and its effect. This principle builds trust among stakeholders and shows stability in accounting practices. So, let's move on to materiality. Materiality means we have to record only important and relevant information. It means that financial statements should only include information that is significant and relevant to users. Ignore small and unimportant details for simplicity is another concept that is covered in materiality, which means unimportant or small items can be ignored for clarity and simplicity. For example, a calculator or a stapler can be recorded as an expense rather than an asset. This helps us to focus attention only on the information that really affects decisions. Now let's move on. Full disclosure. Full disclosure ensures that all the important and relevant facts are presented in the financial statements. Nothing that could influence a user's decision must be hidden. So, this includes details like pending court cases or contingent liabilities, which are shown often in the footnotes. It promotes honesty and builds trust and confidence among the investors and the creditors. Now let's move on to the importance of accounting conventions. Accounting conventions help bring uniformity, reliability, and comparability in financial reporting. They make it easy for the comparison of companies. They act as a common language which provides common understanding among the stakeholders so that the analysts and investors are easier when they understand different companies and compare it. By promoting ethical and transparent practices, they strengthen confidence in financial statements. They also act as a guide when no formal accounting standard is available. Now let's move on to Introduction to IFRS. IFRS stands for International Financial Reporting Standards. These are developed by International Accounting Standards Board IASB, which aims to make financial reporting uniform, clear, and comparable globally. It wants to make the financial statements understandable and comparable across different countries. And today, more than 140 countries have adopted IFRS. India follows its version called INTAS, which is closely aligned with IFRS principles. Difference between GAAP versus IFRS. GAAP is also known as Generally Accepted Accounting Principles. It is country specific and rule based. IFRS, on the other hand, is global specific and it also looks for a global and wider scale. This is principle based. GAAP focuses on legal form of transactions while IFRS emphasizes their economic substance. This makes IFRS more specific and flexible and suitable for international reporting. Importance of IFRS. IFRS ensures that there is transparency and comparability worldwide. It means that it ensures that all the companies present their financial report in a way that is easily comparable and it is transparent. This helps the investors the the analysts to easily compare the financial statements across the world and helps to evaluate these statements easily. It reduces confusion. Earlier, every country had its own system of accounting which caused different kind of confusions. When IFRS came, it helped to set a generally accepted and one global set of rules which reduce the misunderstanding between investors and shareholders of the companies and the analyst, which then created harmony in the financial reporting. It acts as a uniform communication, which means it acts as a global language or common language across the borders and makes it easier to promote uniform financial communication. And the last, global operations, which makes it easier for global companies to operate, which also simplifies the cross border mergers, acquisitions, and investment overall, promoting confidence and uniform communication in the global finance. In conclusion, accounting conventions ensures that local reliability and fairness is promoted across the world and different countries. IFRS promotes global harmony and consistency. Together, they help accurate, ethical, and trustworthy financial statements, and they perform foundation of responsible financial management. So this is the end of our presentation. Thank you for listening. Have a good day.